Hey, what's up, guys? This is Hasten. So, welcome back. We got a lot of series that we're going to talk about personal finance, how to manage your cash flow, budgeting. Especially today, we're going to talk about mortgage. Dr. Albert is going to talk about like three things today. So, the first is what is mortgage, and the second would be the mortgage calculation, and the third would be what should be our concerns when we get a mortgage. Before talking to your mortgage broker or your banker, there are some tips that Dr. Albert is going to share with you.
Hi everyone.
Hello. Mhm.
Hi everyone. I like to use an Excel worksheet to demonstrate what we're doing, so that we can actually see the numbers. Not only that, you can actually download the Excel worksheet. So by the time we finish, you'll be able to play with the worksheet by using the file that I'm going to provide with this video. Okay, so I'm going to share the screen with you, and we're going to go into the worksheet. Now, as you can see in this worksheet, we actually have three tabs. One is for Canadian mortgage, one is for US mortgage, and one is for mortgage in Hong Kong. Now, there are differences, and we're going to talk about the difference uh, in mortgages in these three major areas. Um, but let's start with the Canadian version, right? So when you go and buy a house, uh, you know, say $300,000, you probably don't have $300,000 in your pocket. Even if you have it, you probably don't want to just spend it in a house. So what you do is that you borrow, you go into a bank or a financial institution and you borrow that money. So how do you decide? Well, it depends on how much money that you want to put down as equity in the house. In Canada, as well as in the US, what we like to see as a banker would be for you to put down 80%. So 80% is the cutoff. If if you have uh, less than, so 80% is 20% equity, right? So if you have less than 20% equity, that means that if you want to borrow more than 80%, then the loan is considered to be high ratio, and therefore a lot of times actually most of the time the lender would ask you to buy insurance called mortgage insurance to protect them, and the premium for that insurance would be added to the mortgage. So this is something that you need to consider, is whether your mortgage is high ratio, that means that you have less than 20% equity, or low ratio, which is you have more than 20%. So that's the first consideration. So obviously, the more money you put in your house, the lower the mortgage amount, and probably the better off from a cash flow perspective. The second consideration is the amortization. So what is amortization? Amortization is the time it takes for you to pay off the loan. In Canada, the typical amortization period is 15 years, 20 years, 25 years. And in the last couple of years, we have seen mortgages that is amortized for 30, even 35 years. Now, if you go into the bank, you don't ask for a particular amortization year, which you should, by the way, then the starting point would be that if they use 25 years or even 30 years if they think that they want you to manage your monthly payment. The shorter the amortization, the better, obviously, right? So that's something that we'll work on this number later uh, when we talk about in the future episode when we talk about how to pay off the mortgage as quickly as you can. The next two numbers are the two numbers that usually come together is the interest rate, the rate of interest of the mortgage, and the term. Now, in Canada, the term is much shorter than in the US and in Hong Kong. The reason why that's the case is because of the fact that in Canada, most lenders actually have to borrow money, either the bank or the other financial institution, to lend you the money, right? And so they have to go into the capital market and the money market to do that. And because of the fact that the Canadian market are a little bit smaller, uh, it's much more difficult for them to raise money that is more than 5 years. So most of the mortgages in Canada is 5 year term.
Hmm.
There's some that's 7 year term or 10 year term, but mostly it's 5 year term. Now, that what it means that is that the the lender actually commit to a particular rate only for 5 years. So even though that your amortization is 25 years, after 5 years, you have to go back to your lender to negotiate a new rate, right? So at the time when the rate, so for example, 5 years from now, the rate has gone down to 2%. Well, then you have the good, right? Then you can find another 5 years for 2%, 2.5%, or the rate can go up back up to 20%, like in 1980, in the early 1980s. Well, in that case, you just have to take that 20% rate at the time, right? So this is the term. The term is the period of commitment that the lender would commit to the rate. Now, in the USA, because the market is much bigger, you actually see mortgages that has a much longer term, like 10 years, or even the rate are committed for the whole 25 years or 30 years for that matter. So that's the difference between the Canadian market and the US market. Now, once you have decided on these four numbers, then we can actually calculate the monthly payment, right? So in this case, if you have a $250,000 mortgage and amortization is 25 years, and the interest rate is 4.5%, and the monthly payment would be about $1,384, right? So that's how the calculation is done. Now, before we actually go on to uh, the detail of how the payment works, do you know the difference between the Canadian way of calculating interest and American way of calculating interest, Hazen?
No, no, not exactly.
Well, so in Canada, the way that mortgage interest rate are calculated is actually dictated by the Interest Act, which is over 100 years old and has not changed
Hmm.
substantially, right? So the way that it's being calculated is called compounding, but it's compounded semi-annually, not in advance. Now, this is the only type of loan in Canada and in North America, in fact, that would be compounded this way. In the US, and I'm going to show you later on under the US mortgage tab, US is monthly compounding, right? So it's just like the
Okay.
loans that we have in Canada, as well as the loan in the United States. They're monthly compounding, so the calculation is a little bit different. And you can see that the US mortgage is a little bit higher than just a few dollars higher than the Canadian mortgage. Okay. So now that you
Hmm.
pay, about $1,384 a month, how would the mortgage be paid off? Well, how the mortgage is being paid off is actually depicted in what we call a mortgage amortization schedule, right? So the
Hmm.
schedule is basically a detailed uh, uh, description of how over time your payment is being applied to your mortgage, how the interest is being paid, and the loan is being paid. So let's just walk through it a little bit. So for example, we have in our example $250,000. So before at the beginning of the mortgage, you have $250,000 only. The first month you make $1,383.68. Out
Hmm.
of that payment, you know how much money that would go into interest? 900.
Actually, a lot.
Yeah, it's actually a lot, right? So you can
Yes.
actually see that, $928.83 go into the interest, right? So this
Hmm.
interest is the interest on the total amount that you own, which is $250,000, based on the
Right.
monthly interest factor calculated by the interest rate. So you
Right.
pay the majority of the payment go into interest, and you only repaying the loan for tune of $454.85. So at the
Hmm.
end of the first month, according to this schedule, uh, you own $249,545, right? Now, the
Right.
second month, you make the same amount of payment. This time, do you notice that this interest is slightly different, right? the interest
Decrease a little bit.
yeah, decrease a little bit. Why?
Because the principal is reduced. Yeah,
yeah,
reduced by 454.
your principal is reduced by 454. So you own a little bit less. So therefore, you pay a little bit less interest and you pay a little bit more principal, right? So at the end of the second month, you owe $249,088, right? So this having this table around would show you uh, at any given point in time how much money you owe the bank or the lender on the mortgage. Now, this is useful in a number of ways. Number one, if you want to pay off the loan after, say, 10 months, then you will know exactly how much money that you need, right? So up at the 10-month mark, right, you're about $245,000, right?
45.
Now,
Yes.
it would take a little bit more than that amount to pay off the loan. You know why? Well, the reason why you need a bit more is because you have to pay penalty, right? So this is where the term comes in.
Right.
The term is 5 years, so you're committed to borrow the money for the next 5 years. And if you want to break the contract and you pay off the loan early, the bank actually, when you borrow the money, the bank actually give you a disclosure statement that would tells you how much of a penalty that you need to make before you can actually break the contract. Okay, and usually it's about 3 months worth of interest that you need to pay. So this actually could be a substantial amount. So therefore, how do you decide on the term of the contract is actually very important. Now, there's no general rule, right? How do you make the decision depends on a number of things. One, of course, is the rate structure at the time, right? So if most of the time, the longer the term, the higher the rate, right? But on the other hand, you have stability.
Right.
On the other hand, it depends on whether you want to sell the house, right? So if you're going to stay in the house for the rest of the 25-year term, well, then the decision would be purely on the rate, right? However, if you say, I'm going to buy this house for 2 years, and then I have a baby, and then I'm going to look for a bigger house, well, then don't go into a mortgage that is lower than 2 years, because if you want to sell your house, move to a bigger place, and get another mortgage, you may have to pay penalty for it, right? So those are the things that you need to consider when you take on a mortgage is your personal circumstance and how long you're going to have this mortgage for according to your projection on what's going to happen in the next few years. So this is the basic, right? So this is the basic things that you need to know about the mortgage. In later episodes, we're going to talk about various ways that on how to pay off the mortgage early. As you can see, the mortgage amount is the largest amount of loan that you're going to take out in your life. And what you want to do is try to get rid of it ASAP. And there are ways that you can actually do that, right? So, and how do we do that? Well, we need to know a little bit about the arithmetic behind the numbers, and this amortization schedule would be the foundation under which we can understand the mathematics of it. Now, before we leave, let's just look at the U.S. situation, right? So same loan, 250,000, 25 years, same rate. The amount is a little bit higher, right? As I said, because of the compounding is a little bit different, so therefore the numbers are a little bit. Now, Hong Kong, I have a tab for Hong Kong. And obviously, the mortgage amount is a much bigger number because they have much higher real estate, and then, of course, the exchange rate. The way that the interests are calculated is exactly like the U.S. So different countries has different way of calculating, but primarily Canada is different from other countries. Okay, so that's the basic calculations that we need to know about. And as I said, in the next couple episodes, we're going to talk about ways that you can actually improve on, the payments that you can make, and you can actually pay off your mortgage a little bit earlier. Okay.
That is very important. So hope you guys like the video. So like, comments, and subscribe. Thank you very much, Dr. Albert, for sharing, the key things that we need to know when we get a mortgage. So in the future episodes, we're going to talk about different topics such as, oh, should I pay mortgage payment, monthly, or, semi-monthly, or bi-weekly? The calculation matters, right? So we're going to share the Excel file in a link. Is on our YouTube channel. So stay tuned, and I will see you soon. Thank you, guys.
Yes,
Bye.
and also before we go, actually, I would like to also invite
Mhm.
you to make comments if you have any question that you want answer. Just feel free to ask us
Right.
in the comment section, and I will try my best to answer them. Goodbye.
Yes, thank you, Dr. Albert. Goodbye.